Welcome to Taking Stock for the week ending the 10th of September 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to you all things share market. Well, last week we spoke about the market cycle and how we've transitioned from an expansion phase to a slowdown phase. Now, the expansion phase follows on from the COVID-led recession, and that's usually when markets returns are the strongest, with the All Ords Index and the S&P 500 rising by 30% and 38% over the last financial year, respectively. Now, the chart on screen shows the market cycle, and that's represented by the OECD indicator, which is a leading indicator of economic activity and represents turning points in the business cycle. So why is this indicator important for investors? It's because there is a strong correlation in market returns with this cycle, as you can see on the following chart with the All Ords represented in yellow. And the peak in the OEC indicator suggests returns from here will be harder to generate.
Yeah, and companies will need to rely on their fundamentals to drive capital gains. The speculative mania across unhealthy businesses is ending, and the returns you achieve on your portfolio will be more dependent on the quality and financial health of the business. But that said, with interest rates expected to remain low and vaccination rates increasing, we expect market returns to be positive for this year.
Yes, Jake, and the easy money has been made, as you said. Over the year, the strength in the market has been fueled by this significant central bank stimulus, but now this is expected to unwind. The Reserve Bank of Australia has announced that it will imminently taper its bond purchases from 5 billion to 4 billion per week. And the European Central Bank also said that it will slow down the pace of its bond purchases as well. And this has caused some volatility in the market during the week. And news of a wind back in bond purchases has led to a rise in bond yields. And if this continues, it should in turn benefit the cyclical stocks in your portfolio. And these include the financials, the materials, and also the discretionary stocks. And some of our star stocks in this space include Aristocrat Leisure, Macquarie Group, Netwealth, James Hardie, Credit Corp, Wesfarmers, Lovisa, and Oz Minerals. So speaking about these star stocks, let's now turn our attention to some of our star stock initiations over the week. Following the reporting season, the research team have been looking for new opportunities, and many of these are cyclical businesses that tend to do well when bond yields are rising. So let's start with Bullline and Star Income stock Perpetual, a value-orientated fund manager. Now, the group has expanded its presence in the US and has some exposure to ESG or environmental, social, and governance investing. Unlike X-Star Stock Platinum Asset Management, Perpetual has a strong fund outperformance, and they've been expanding their distribution channels to support fund inflows. Earnings are now diversified internationally, and this should support earnings growth over the next 2 years. In addition, we believe the gross dividend yield of 6.8% is sustainable and attractive, with a payout ratio around 80%, which is below its historical average.
Yeah, and another star growth stock initiation in the financial space is MA Financial, a group which provides asset management, lending, and corporate advisory services. Over the years, MA Financial has been able to grow assets under management by diversifying into other areas, including credit and listed and private equity. Earnings are expected to grow high double digits this year, with management confident on the outlook.
And I noticed CEO Chris Wyke, he holds a significant stake in the business at 9.5%, although investors considering a position in the stock needs to be mindful of the liquidity, which has an average daily trade value of around 330k. And another addition to the Star Growth universe this week is West African focused gold miner called Perseus Mining. The company is targeting a 75% uplift in the first half 22 production, and this is translating to 88% earnings growth for the full year 22.
Yeah, and having gold exposure can help you hedge against share market volatility. But before making an investment, you need to be comfortable with a gold miner that operates across Ghana and the Ivory Coast, where there can be political instability. Another stock we initiated on this week is specialty retailer Chic Collective. The company is a global retailer that specializes in women's apparel, footwear, and accessories, and earnings are also diversified globally. Impressively, the company has expanded its net profit margins by translating to a global digital retailer with 70% of total sales generated via online channels.
And although many retailers have performed well during COVID on the back of those government handouts and stimulus, unlike many others though, City Chic is expected to grow strongly with consensus anticipating earnings growth of over 60% for this year. And there will be other Star Stock initiations expected to be rolled out. So keep your Stock Doctor alerts active and refer to our commentary to keep you abreast of all these opportunities.
Yeah, and turning our attention now to our calendar, there are no star stocks reporting next week. However, there are a handful of star income stocks going ex-dividend, including Breville, Lovisa, PWH, Spark New Zealand, and carsales.com. And for the trend-sensitive investors, Collins Food turned bullish on the SD Max, that is the Stock Doctor moving average crossover, and on the SD30 TSR, the 30% stop loss. Brambles signaled a re-entry, while Accent Group triggered an exit.
And for Under the Microscope this week, we look at our new star growth stock, Lynas Rare Earths. The code is LYC. As the name suggests, Lynas produces rare earth elements using technologies such as mobile phones, batteries, and fiber optics. The investment thesis here is driven by rising demand for magnets in hybrids and electric cars and the increasing shift towards clean energy.
Yeah, and geopolitical tension between China and the West has led to a rise in rare earth oxide prices, and this has allowed the company to generate strong profits over the last financial year, despite operating at 75% capacity with a return on invested capital at 28%. Meanwhile, earnings growth is anticipated to be very high in the coming year on the back of growing demand for these vital elements. However, before any potential investment, investors should consider the risks. Firstly, earnings are tied closely to the price of rare earth oxides, and this can lead to a volatile earnings growth profile. COVID restrictions on the workforce numbers in Malaysia may also continue to impact operations. And lastly, rare earth mining can cause enormous environmental damage because it does generate large volumes of toxic and radioactive materials. Although Lynas has met environmental guidelines, it faces legal challenges and opposition to its waste store plans.
Yeah, and positively though, the company is constructing a secondary processing center in Kalgoorlie to reduce its dependence on its operations in Malaysia. Also, we note that the company is run by CEO Amanda Lacaze since 2014, who has saved the company from near collapse in 2015. She currently holds around 26 million worth of shares, which shows a vested interest in the company. And lastly, it's also good to see short interest come down from a peak of 7% in 2020. A number of our members have asked us about the revision to our Star Growth Stock Quant model. We've provided an overview in our most recent Stockroom webinar, and we'll be releasing additional details over the next couple of weeks. But in the last year, we've taken the opportunity to view the coronavirus not as a threat, but rather an opportunity to help our members navigate the uncertain landscape.
Yeah, and our unwavering commitment to support our members prompted us to invest heavily into R&D in both the Stock Doctor platform and our Star Growth Stock selection methodology. We've bulked up our quantitative capabilities by employing a new quant analyst, Warren. Furthermore, we have leveraged industry-leading financial providers like Bloomberg, FactSet, and Standard & Poor's to help us build a more robust testing environment. Our goal is to remove much of the subjectivity from the decision-making process as we move to a fully quantitative model.
And I'm proud, Jake, to say that the testing we've done on the new quant model has shown improved results on our original model. We'll be introducing this iteration of our quant model to our Star Growth stocks, and this enhancement should improve the portfolio returns for our members and provide a much more objective approach to investing. Now, transitioning to this revised model will mean there will be a rise in the level of stock turnover. But rest assured, once this transition period is over, the level of portfolio turnover will be quite low.
Yeah, and our star income stock selection strategy will remain the same. Assessing the sustainability of a dividend requires qualitative assessment of its dividends in the future and consideration on how long a stock can be held to capture ex-dividend and payment dates. We'll begin to implement our optimized quant model in stages, and this is to enable our members to access the opportunities earlier while we work on updating some of the features and functionality of Stock Doctor with this new model. We have a major Stock Doctor release in late November where our members will fully experience enhancements of our platform. We'll be conducting webinars and we'll have educational materials available to guide our members through the changes. We'll continue to keep members informed along the way.
Certainly a very exciting time, Jake, and thanks again for your contributions today.
Thanks for having me on again, Kien.
So on the back of this potential recovery in bond yields, it does make sense for clients to look for opportunities within the cyclical space, such as the financials, the materials, and discretionary sectors. We have initiated coverage on a few of these stocks, and there will be more to come in coming weeks. But make sure you use the Stock Doctor tools to keep track of all the star stock changes. And these tools were highlighted at the end of last week's Taking Stock video. In the meantime, have a happy, healthy, and prosperous week, everyone.